Hey everybody, it's Friday, October 10th, 2025. We'll start with our headline: Trump controls the stock market and the 10-year note yield controls Trump. The S&P 500 fell today by about 2.7%, along with Bitcoin dropping almost 4% today. Overall, it was a pretty big risk-off day, and the narrative is that it's because Trump threatens massive tariff hike on China over rare earths dispute. I want to point out that before we got wind of the tariff threats, the new tariff threats from Trump, this morning crude oil was crashing in light of Israel Defense Forces' announced ceasefire agreement in Gaza. The news of these tariffs hitting did not really hit the news until around 10:30 this morning, but crude oil had already been crashing since much earlier in the morning, finding new lows that we haven't seen since 2021 as of 8:30, 9 o'clock in the morning, and then continuing lower through the day. Now, taken into consideration that the 10-year Treasury note yield on Liberation Day did drop for a few days, but then rallied higher and higher, which is why the giant tariff button got paused. And also remember that the U.S. 10-year Treasury note yield is very much affected by the price of crude oil. So the whole point that I'm trying to make here is the timing of this news regarding tariffs coming out right after the fact that crude oil is collapsing, perhaps because of potential peace in the Middle East, is no accident here. And remember, the whole point of everything that current government is trying to do here is the US is in a very bad fiscal debt situation. And the 10-year Treasury note yield makes it worse. When you have the percent yield in the secondary market on longer dated treasuries being too high, the amount of money that the government has to spend just to service that debt is an enormous part of what they have to spend. They need the 10-year Treasury note yield to go down, which is why it controls Trump. And I don't think it's an accident at all that we are in a situation right now where crude oil starts crashing and the immediate thing to do is to threaten tariffs right out of the gate. The whole point of all of this, if you're following it or not following it, is that really we need to watch two things moving forward to get an idea of if the stock market is going to once again be saved by Trump or not. Look at credit spreads and the 10-year Treasury note yield. That's it. In order for the tariff threats to be taken off the table and the S&P 500 to go higher again, I'm going to suggest we need to see the 10-year Treasury note yield be threatened that it is going higher. As long as the 10-year note yield is falling, then there's no reason for Trump to try to save the stock market. Additionally, keep an eye on credit spreads. I have been talking all week about HYG divided by SHY accelerating to the downside, and we got a further acceleration to the downside today. And while we're talking about this chart, I want to share a very, very frightening, scary, or interesting trend line that I think you guys will be fascinated by. This blue line that you see right here represents HYG divided by SPY. And this thing goes back to the top of May 2013. And we have been bumping our heads on it over and over and over and over again. We cracked above it to the upside in June, and then today we landed on it. I think that's a very highly interesting chart. If you want to do it yourself, you can go to tradingview.com and look up HYG divided by SHY. SHY is the government debt ETF that matches the closest matching duration to HYG, a junk bond ETF. Just one more view of it on a monthly time frame. Again, from the peak in 2013, we've hit it many times in the past. As you can see here, broke through it and we landed on it today on the upside of it. So again, if credit spreads continue to widen, if HYG divided by SHI continues to fall, and the 10-year Treasury note yield continues to fall, Trump will let the stock market continue to fall until we see something different going on again with the 10-year Treasury note yield and credit spreads. Moving on to community topics. And we do have more charts to go through at the end, so stick around. But before then, community topics. What moves, if any, did you make today? Robschild sells SOXS. Yeah, I was short SMH and did well with that today. Sold it. Had some calls that expire on the VIX this next Friday, so I sold those at a pretty good profit. And some of the HYG puts, which I had expiring next week, also at a profit. What did you do today? Comment below. I'll add that the Robschild portfolio actually rose today, believe it or not, by about 0.9%. Coming up, economic data is still in limbo, friends. We don't have 2 weeks now of initial and continued jobless claims. We're still missing that very important unemployment report. And what have I been saying on the show? Every show. Look out for those tariff updates. I want to add in here, too, that the economic data in limbo, I've been predicting with my crystal ball. I said that I think this might end around October 20th. I'm understanding the last time we had a government shutdown was for over a month, so this could stretch on longer than what my crystal ball is seeing here, but I guess we'll see. As always, thank you for watching, liking, subscribing, commenting, and supporting Robschild. No changes to the crystal ball ratings. And see my website, link in the description for my daily reminders, current macro views, portfolio explained, and stock research center. On to the charts. So pretty big move down in the S&P 500. I believe we haven't seen a move down this far in one day since April, since the Liberation Day sell-off. And like I said earlier, we had Bitcoin. Right now it's about 6% down on the day. And I am still short Bitcoin because I think this is the top of Bitcoin for a while. I'm actually, believe it or not, looking for an 80 plus correction in Bitcoin. I know that sounds a little crazy, but I am crazy. Look at me. But anyway, yeah, I like I said in previous shows, I got into my short at this orange line connecting the 2017 high to the 2021 high. Got in the short there, quadrupled it in this area up here, and I'm still holding it right now. But I digress. The triple Qs, the NASDAQ, also dropped quite a lot today, about 3.5%, taking out so many candles. What a large move. SMH also dropping 5.8% today. This is the semiconductor index. IWM small caps also dropping 3% today. Now, it's the stocks that are dropping that are going to hit the headlines that most people are going to be paying attention to. But like I said, crude oil had been dropping to lower lows that we haven't seen, and it wasn't since 2021. We were in that range back in April and May. Sorry about that. But we haven't been this low in a while. And, ever since bumping around in this range since August between 61 and 65, like I've been saying, eventually this would break out, and either way is bad news. To the upside is putting a squeeze on businesses, and going to the downside means that no one's going to want all the oil that they're expected to produce. Suggesting the economic slowdown is here. I can't stress how important it is to understand this was happening before we got wind of the tariff situation. And I do think it is on purpose to try to get yields to go lower, like I'm saying. Trump wants to spend money, and this is how we do it. You have to lower the cost of debt, which typically follows crude oil. Now, believe it or not, I'm not going to say today, hey, I told you so, yields were going to drop, because they didn't drop enough. The 10-year Treasury note yield, it dropped by 8 basis points today, but we didn't even get to the low of mid-September, interestingly. And so this is why I keep saying this is the thing that we need to watch. Where does the 10-year treasury note yield go? I am figuring that as long as crude oil is, you know, where it's at right now or continues to drop, that the US 10-year treasury note yield will continue to follow. But this is the thing to watch. It's this chart here that'll help us figure out what the next move is. And I can't repeat this enough times. As long as the 10-year treasury note yield is not going up, and it is going down, then there is no reason to try to save the stock market. Now, many people watching this might be wondering why I'm not suggesting that stocks going down would be a bad thing, because it isn't a bad thing when stocks go to normal healthy valuations. The AI bubble we're in is very dangerous, and for it to deflate is a positive thing for everybody, in my viewpoint. I've been mentioning on the show the VIX being oddly low for so long, especially with, the government being shut down, by the way, too. That's something I didn't even mention today. No, I did. I covered that in the coming up section. Anyway, regardless, the VIX finally spiked and we are above 20. So we are in fear mode. I see it as healthy fear mode. I don't think it's good, again, for stocks to be overvalued. I no longer have any exposure, though, to the VIX myself because I don't know what's going to happen over the weekend. Funny enough, a good deal with China, may send the VIX straight back down, and who knows? Maybe the bubble will continue. Maybe until we finally get those jobs numbers that show, the real problems beneath the surface. I've been mentioning on many past shows the high yield credit spread spreading and how this updates in the morning. I said we're not going to see it till the morning. It'll probably spike up, and yeah, it did for this morning. And then on Monday, we should see a much higher high. Especially considering how much further HYG divided by Shy dropped today. I also want to bring up the king of the stock market, Nvidia, dropping by 4.9%, engulfing many candles, including the doji that we had. If you remember yesterday's headline, I said the top is in. It looks like it might be. It looks like my crystal ball might be right after all. Next, TLT, my favorite place to be, the upside down of the 10-year treasury note yield, essentially. The duration's longer. But anyway, TLT went up by 1.6%, interestingly, today. And gold only went up by 1% today. But I do find it notable that gold did not drop today. Combine all of this with the U.S. Treasury 10-year note yield not dropping below 4% yet, it still suggests that the market is sort of waiting to see, what the hangover effect of this new tariff deal is. Are we going to see are we going to see U.S. debt get bought? Are we going to see the U.S. 10-year Treasury note yield drop, or are we going to have a similar thing to what had happened back in April on Liberation Day, where all of a sudden it turned around and the 10-year note yield started spiking higher? Also, while TIP divided by IEF fell, representing inflation expectations, along with the 10-year break-even inflation rate itself dropping a pretty good amount today, 4 basis points, getting to a low we haven't seen since July. 2.3%. This isn't at 2% yet. This isn't below 2%. Are we headed there? I think we might be this time. The real thing the bond market needs to ask itself is, where's the economy right now? Where's the jobs market? Missing that employment data, and initial claims plus non-farm payrolls now for week after week. We need this data. If it hits the tape and it is, our employment data, non-farm payrolls, for example, is negative, if we start seeing the idea that ADP employment numbers are right, and that people are actually losing jobs, there's not enough jobs for all the people that are unemployed, markets can fall, and they can fall a lot further than most people think. Most people, they don't understand valuations, they don't understand earnings, they don't understand what a stock represents. They don't understand what a stock price represents. The S&P 500 dropping by 50% from here would simply bring us to a more normal historic valuation. And if we do fall that far from where we are, it's likely in my book that we'll probably go lower than that. But remember, guys, I'm just a guy with a crystal ball, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.